Okay, hello students, welcome to my class. This is Professor Vincent Osaya, and this is part 2 of chapter 8 presentation. Chapter 8, receivables. In chapter 1, we talk about the overview of receivables, and we also talk about some issues relative to the first objective. Now we are going to talk about how to record credit card and debit card sales. As most of you know, credit card and debit card are two different things, but they are very related. Credit card is a situation whereby you have a Visa or MasterCard from the credit card company, whereas debit card is directly linked to your checking account. So if you buy something with your debit card, the amount goes out of your credit, your checking account directly, whereas credit card, you have to pay the Visa or MasterCard company. Now, nevertheless, how we record those transactions are pretty much the same. Now, I want you to be aware of the fact that we are talking about whose books and records are we talking about here? It is the retailer's books and records. So we are assuming that we are a retailer. So we are not talking about the books and records of the customer, and we are not talking about the books and records of the Visa company, but the retailer. So how would the retailer record credit card or debit card sales? Additional issues that you need to know. A fee is usually charged by the credit card company. Who is charging the fee? The credit card company. Who is paying the fee? The retailer. And the net cash is reduced by the fee. What do we mean by that? So if we buy something for $100 from a retailer, the Visa company might charge the retailer 2%. So the Visa company will pay the retailer $98, even though we are going to turn around and pay the Visa company $100. So there are two methods that we use in recording credit card and debit card sales. The number one method is the net method, and the number two method is the gross method. So let's take a look at how the net method works. Here is an example. So Smart Touch Learning sells merchandise inventory to a customer for $3,000. The customer pays with plastic, that's credit card, and the credit card company assesses a 4% fee. Who is paying the fee? That is the retailer. Now let's take a look at how we make the journal entry, or how we record it. Again, we are ignoring cost of goods sold second journal entry that we normally make. So we debit the cash. So for the retailer sales revenue clearly is $3,000. So we credit sales revenue for $3,000. The retailer is going to debit cash for $28.80, because when you buy something with credit card and it's approved, that is just as good as cash for the retailer. So therefore, the retailer debit cash for $28.80. Why $28.80? Because the retailer is going to get $120 less than what you would have gotten because of the 4% fee that is charged by the Visa company. So the retailer would debit credit card expense for $120, just part of the cost of doing business, and cash is debited for $28.80. Now, let's take a look. In contrast, let's take a look at the gross method. The gross method, from the outset, same example, would record the transaction based on the gross amount. So in this case, the credit card company debit cash for $3,000 and credit sales revenue for $3,000. Now, however, at the end of the month, take a look at what happened. The credit card company, not the credit card, the retailer will make an adjustment and debit credit card expense for $120 and credit cash for $120. So by crediting cash for $120, cash account is being reduced by $120. Originally, it was debited for $3,000, credit for $120. The net would be $28.80, just like we had when we used the net method. Moving along, here is another example relating to what we just discussed, and we need to try this. So you can go through this on your own. Okay, so let's take a look at objective number 2. So we are going to apply the direct write-off method to uncollectibles. And before we talk about how to apply the direct write-off method for uncollectibles. Let me give you some overview of what is happening here. You need to listen to this very carefully. Remember, from the outset, we said that there are three parties involved when we use plastic card. Now listen to this carefully. Sometimes a company will extend credit to the customers without getting the Visa or MasterCard involved. So what are we talking about here? So that will be between the customer and the company. All right? So there are some departmental stores that actually extend credit to customers. I think J.C. Penney have their own credit card without getting the Visa or MasterCard involved. So guess what happened? What is the benefit to you and I? We are able to buy and enjoy more often than not, unfortunately, what we cannot afford now. And for the company, they are able to generate what? More sales than they would have been able to generate in the first place. And the more sales you have, hopefully and prayerfully, that will translate to what? More profit. Because if your competitor is extending credit to customers and you are not, your competitor is going to generate more sales, and very likely they are going to realize more profit. Now, so that is the benefit for the retailer. Now, the retailer will pay a price for extending credit to customers. What is the price that they pay? The fact of the matter is, some customers will not pay. May not pay. Some customers will never pay. Why? Because they are bad people, they lose their job, they fall ill, they couldn't pay. Whatever the reason is, the fact of the matter is just a fact of life that some customers will not pay. So those accounts that you are not able to collect, we consider them as bad, uncollectible accounts. In other words, the accounts that you are not able to collect. So that then results in what we call bad debt expense. So by extending credit to customers, companies have to absorb the cost of customers that don't pay. So we call that bad debt expense. Now, question. Why would a company continue to extend credit to customers when the company knows that some customers will not pay? The fact of the matter is, more often than not, the benefit of extending credit to customers usually outweigh the cost or the price of doing so. As you know, we talk about cost and benefit analysis in business. Whenever the benefit outweighs the cost, it's worth it to engage in that activity. So companies will continue to extend credit to customers as long as they come out their situation ultimately is better than not extending credit to customers. So having said that, the question now is, how do we calculate or measure bad debt expense? How do we measure bad debt expense? So that is the issue on hand. We say we have two methods of doing so. Number one method is called the direct write-off method, and number two method is called the allowance method. The allowance method has three types. We are going to talk about it in a minute, but I want you to know at this point that there are two methods. One is direct write-off, and number two is allowance method. So let's zero in on the direct write-off method at this point. Now, listen to this very carefully. The direct write-off method states that at the end of the year or at the end of the accounting period, you should not recognize bad debt expense except when you actually know for a fact that a particular customer would not pay. So listen to this carefully. So assuming that this is your first year in business, and at the end of the year, nothing comes to your attention that a customer will not pay. So you are not going to recognize or record bad debt expense. Now, if you do that, in that particular year, there will be no bad debt expense. And we said previously that it is not a matter of whether our clients are going to stick you up or not. It's a matter of how many of them will. So the direct write-off can go for a particular year without recognizing bad debt expense. So that is a violation of the matching principle. So I want you to know from the outset that the direct write-off method is not GAAP. It's unacceptable. It is not generally accepted accounting principle. Then why are we talking about it? Because there are some situations or circumstances whereby the direct write-off method is okay. Now, let's take a look at how the direct method works. Let's take a look at an example here. Suppose maybe at the end of the second or third year, the company realized that $200 from Dan King customer would not be collected. So in that particular year, the company will make an entry and debit bad debt expense for 200 and credit accounts receivable for 200. Well, by crediting accounts receivable is being written off. Now, let's assume that Dan King won the lotto and call you up and say, oops, I owe you $200 7 months ago. I know you have written off the account that I'm willing to pay now because I just won the lotto. What are you going to say? Oh, I don't need the money anymore because I've already written it off? No, you're not going to say that. You are willing to accept the money any day, any time. So the question is, how do you record that? How do we account for that? Take a look at what happened. 2 entries. Number 1 entry, we have to reverse the write-off that we recognized or recorded previously. Remember, we debit bad debt expense and credit accounts receivable, we reverse it. Now we debit accounts receivable and credit bad debt expense. Then we make the journal entry. We gladly receive the $200 and say thank you very much, and debit cash and credit accounts receivable. So that is the conclusion of part 2 of this presentation.